Good evening, everybody. Kind of a chilly evening here just north of Pittsburgh. All right, tonight we're going to concentrate on kind of look into what we're going to be going over in Saturday's training. And the reason I like to show this indicator is because it basically solidifies what the trend is actually doing uh, based upon the combination of the T-line and candlestick signals. So our basic T-line rule is that if you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. Now, this was important when I first learned it because without the T-line, I was making good money, but I would close out positions when I thought it was time to take profits. But then when I added the T-line, I discovered if you just use that rule, you keep yourself in positions where you're not making decisions because you think it's time to take profits or that you should be taking profits because you sure would look stupid if you let that profit go back to being a loss. So this T-line rule has one strong aspect to it, and that is that if you see a candlestick buy signal or close above the T-line, again, I stress this word, you have an extremely high probability an uptrend is being confirmed. Same side or same scenario on the downside. If you see a candlestick sell signal, you can stay short until you see a candlestick buy signal and a close back up above the T-line. This is very important because that same truism works that when you see a close below the T-line, you have an extremely high probability you're now in a downtrend. So that function of the T-line kind of enhances, let's see, if you're long and the candle is way above the T-line, how much profit are you willing to give back by not having a stop in? JQ, that's the caveat to the T-line. The caveat is the further away you move from the T-line, the higher the probability it's going to come back and test it. So that means once you start visually recognizing that you're too far away from the T-line in the overbought area, that's where you get a lot more attentive of putting in a stop. So this one was a good example that if it opened positive and started trading positive, where was the logical place to put a stop? Right there at the open or the close of the previous day. Because if it came back down through there, what can we assume? The probabilities say it's selling off and eventually coming back to the T-line. So this is a good example of using the T-line, when to buy and when to sell, just based upon some very easy observations about where the location of the T-line is compared to trading. It also keeps you from getting out of a position. There's your strong signal. There's your close above the T-line. Shows you exactly when you should be entering this trade. Right in here, that would have been a little bit dicey. But notice what the basic rule was right here. They could never close it below the T-line. That's why we're still long this position. So the reason I'm pointing this out is the T-line is very effective. I should stress the word very, extremely critically effective for keeping your emotions out of your trading. Sonny is just visually looking at it. That's a good distance away from the T-line. That's a good distance away from the T-line. So what is the visual, just a quick visual analysis? You're in an overbought condition. You're that far away from the T-line. What should you be getting ready to do? Two things. One, you should be very alert that you should be taking profits if they start selling off. And two, we go to the 10-minute chart to see when it's time to start taking profits. Again, this is all stuff that we're going to go through step by step on Saturday. Now, the bad news is you're going to be looking at hundreds and hundreds of charts. It's going to be a lot of repetition. The good news is when you get done with that session, you don't have to remember formulas. You don't have to remember numbers. You don't have to remember anything. All you're going to be able to, or have the benefit of, is when you look at a chart, you're going to instantly recognize when it's time to close out a position. So if you're in an uptrend, where do you put your stop? Just below the T-line. Or if you see it close below the T-line, you're out of that trade. Because remember our T-line rule. You see a candlestick sell signal close below the T-line, the probabilities are extremely high. If that uptrend's over, you're in a downtrend. So this is nothing more than just recognizing the information that the Japanese rice traders provided for us as far as strong reversal signals and adding the T-line, which basically has Fibonacci type characteristics. It acts like a natural support and resistance level of human nature. And when you combine that with the graphics of what investor sentiment is doing, that combination becomes an extremely high probability trade setup. Do you keep a stop loss order on each stock every day or just when it gets away from the T-line? Most of the time, because I'm sitting here, we start recognizing when you're in an overbought condition. Once you're in an overbought condition, you've got some very simple stop loss rules, like putting your stop at the previous day's open. So everything that is built into entry, exit, staying with a position, closing out a position, is all based on common sense of what the chart is telling you. And I'll point that out more, MP, as I find. But here's the logic. If you see candlestick buy signals, especially like in this case, a bullish flutter kicker signal where the doji closed right at the T-line, makes the entry very high probability, a very high probability situation. We know if it opens positive, the doji rule says it's going to trade positive. We also know if it opens positive, it's going to trade positive. The T-line's not acting as a resistance anymore. And then if it opens positive and trades positive, we know what type of signal it's producing, that bullish flutter kicker signal. So there's going to be charts where we look and say, all right, where was the time to be buying with a high degree of probability that not only are you going to be in the correct trade, but the formation of that signal setup shows you're going to be in a very strong bullish trade. we went after Sedge because there was your kicker gap up off the T-line through the 50. Then they kept gapping it up. And then today was kind of a squeamish day in the market. But look what Sedge was doing. After it came down and hit the T-line in the 200, they bounced it right back up again. What's that implying? That this uptrend is still in progress. So if that stock is trading positive, what assumptions can we make? We want to see if other stocks in that sector are acting strong. So we recommended SPWR yesterday because you could see the J-hook pattern setting up. And again, that came off that bullish flutter kicker signal that kept you up above the T-line. So the reason I love pointing out the T-line is that I made good money trading once I started running candlesticks. Again, coming from being one of the worst investors in the world, and I was starting to make money, I was just happier than a pig in doo-doo. But then when we put the T-line on our charts, which was kind of introduced by one of my first private training students, Rick Sadler, because anybody can say, oh, put this or that on your chart and see if it works for you. Well, you put it on there. If it doesn't work after a few weeks, take it off. Well, the T-line just showed constant confirmation that if you saw a sell signal and a close below the T-line, you stayed short. If you saw a buy signal and stayed above the T-line, you stayed long. And there's lots of evidence of when a reversal is occurring. Notice Tesla right now. Where did it bounce when it saw some buy signals here in the oversold area? Right smack dab to the T-line. And that's relevant because it's not like everybody was buying, but they were going to wait to see what happened at the T-line. Nobody has the T-line on their charts. This is an indicator that works extremely well, again, with candlestick analysis, because you can see it acts like a natural support and resistance level of human nature. And it becomes quite evident, don't see any on this chart, but there's so many times where you're looking at a chart and the lows of an uptrend or the highs of a downtrend hit right on the T-line and then go the other way. Now, this is what provides a much more clear visual recognition of what is going on in the trend and investor sentiment. We can see they failed right here at the T-line with a doji. What's the doji rule? It's going to move in the direction of how they open after a doji. If you were aggressive, you would have been shorting on this day. Or you could have been shorting today. Or if this opens lower tomorrow, what do we know about one of our basic candlestick patterns? If it opens lower, more than likely it's going to form a doji sandwich. And what do we know about a doji sandwich? It usually implies there's going to be more in that direction. If that's the case, now what can we analyze off of this chart? Wave 1, wave 2 of a bearish J-hook pattern going into wave 3. Same thing with Amazon. It was an uptrend, dark candle, kind of a belt hold signal. And still was a little bit iffy. Did a doji right on the T-line. Now, what would happen if it had opened positive and traded positive today? We could imply that the uptrend was still in progress. If it opened lower, what was it telling us? The doji rule said it's going to trade lower. Now, where is it? It's back below the T-line. That tells us the probabilities are pretty strong that it's going to head in downward direction. Now, could something happen and it pops up and trades positive tomorrow? Definitely. But the probabilities say investor sentiment is heading in this direction. This afternoon, we were kind of pushing, shorting net. Look at where your bearish kicker signal occurred, right here at the 50, which had acted as resistance before. And then they gapped it down. Not only just gapped it down, but they gapped it down to the T-line and continued to go lower. What should that tell us? That tells us they're selling this off with great enthusiasm, that if this opens lower tomorrow, now there's a good prospect that they're heading for the bottom of the channel, a good short position. So this is all based upon visual assumptions, knowing what should occur based upon a signal, gaps, the T-line. You add all that together. It's not like you're sitting here saying, which one, which one, which one. You can see it all in one glance. So frustrated using this website. Perry, don't know how to answer that. Email me if you're having problems and we'll walk through it. So the T-line probability. Anytime you see a candlestick buy signal and a close above the T-line, assume there's been a major change of investor sentiment. So when we see something like this, what do the candlestick signals tell us? Bullish Harami tells us the buying has stopped. What does this tell us right here? We aren't ready to buy until they close above the T-line. Well, look what they did today. They closed above the T-line. What's that implying? Bullish Harami, bullish engulfing, left-right combo. If this opens positive, what's happened to our probabilities? We're heading higher. Whoops. Where was my illustration? Okay. Oh, that illustration was up here. When we close above the T-line, the probabilities are greatly in our favor that we're heading higher. With the rhetorical question, are we always going to get huge moves like this? Definitely not. But we're putting ourselves in positions where the probabilities of being in big moves like this are greatly in our favor. So if we look at something like this, we can be buying. We don't know whether it's going to go up 4%, 40%, or 400%. All we know is right now the probabilities on a positive open would be in our favor. And we also know what our trade strategy is. We want to stay long as it stays above the T-line. We always have people say, well, what if it opens positive and then comes back and closes below the T-line? The answer is very simple. You close out a trade that didn't work, and you take that money and go and find another one. I found that this harder to do on lower time frames works well on daily or more, but careful on LTF. On LTF. Careful on LTF. Lower time frames. Okay. Absolutely wrong. Now go to some live charts today. I trade off the 10-minute chart when I'm trading intraday. Today I was trading hogs. So it works if you just recite the definition of a candlestick signal, which is basically, it is the graphic depiction of everybody buying and selling during a specific time frame. It works just as well on a 1-minute chart as it does on a monthly chart. So Radu, no, the black line is the T line. The little green line is the 3T line. which we'll be going over on Saturday, of how it works in conjunction with the T-line. But the black line is the 8 exponential moving average. Yep, we'll look at those charts live. Okay, so if you join us Saturday, it's scheduled. The 3T line is the 3 exponential moving average. It also has Fibonacci type characteristics. Works in conjunction with the T line. So for non-members, it's 297. For our members, it's 197. So here's our clever marketing. Just join up as a member for $97. Then you get the $197 price. Even though it's the same price, at least you get 30 days of using the website to see whether it's going to work for you. Oh, I know the answer to that. Frank, but I'll have a hard time remembering. It's line trading something. Bill, no. There is no convergence with stochastics. Stochastics are merely the indication of where you are in a trend. And it has no correlation to what this part of the trend was or this part of the trend. It's telling you what's going on right now. How about a Black Friday price for the webinar on Saturday? You'll get more than your money's worth at the discounted members price. And I don't know how to say this. You're not going to learn formulas. You're not going to learn techniques. You're not going to learn anything other than the visual recognition of where everything's coming together with the signals, the patterns, the T-line, support and resistance. It'll be one instantaneous glance that eventually says, oh, that is something I need to be looking at. All right. Oh, Becky, do you have the link? Okay. Okay, there's the link. All right. Okay. Anyways, I like doing this session because I kind of equate it to being a bad golfer in my day. There was always something exhilarating of being in the tall grass and looking down, and there's a nice, bright, shiny white Titleist 4 sitting there, and it's free, that you know you're going to come out ahead. That's what I get, that same feeling every time I see a setup like this, that there's going to be money made there. Oh, I don't know. I guess that they're probably the same thing. That was your golf ball, all right. Yeah, I'm sure they must be I know it's been so long since I've even looked at all the definitions. Funny, I can't tell you. But the kicker signal is very apparent. as being a drastic change of investor sentiment. See if I can find a clear one. It opens here, closes here. The next day they gap it up at or above the previous day's open and go the opposite direction. It's termed a kicker signal because you can see how investor sentiment has been kicked in the opposite direction. There you go, Darren. Okay, so with that, if we go to live charts, let me expand this out a little bit. All right, so if we look at using that same analogy, the T-line, the signals, you can see what was happening up here on the Dow. We're up in the overbought area. Kicker signal. Then we had a hanging man, a shooting star, a spinning top, a doji. What's that telling us? There's lots of indecision up here. Where is it likely going to consolidate to? Back to the T-line. Are we over in this uptrend? From what it looks like, they're still trading above the T-line. We have to assume we're still in an uptrend. Whoops. Same scenario right here on the NASDAQ. Look where we were up here on this little dark candle, and I think this is more of a hanging man on some of the other charts. But if it opened lower, what would we expect? We expect it's probably coming back to test the 50 and the T-line. You can see what happened today. They opened it right in that area and traded back up. So what do we assess from this? We're not in a reversal just yet because we're still above the T-line. I don't even know whether I can bring the S&P 500 up over here. Same scenario on the S&P 500. Opened lower. Where did they close it? They closed it above the T-line. Now this puts us into two categories. One, we're in a consolidation choppy market. What's that usually say about the favoritism to bullish charts or bearish charts? There's really no great movement one way or the other. How about the gap ups in the last few sessions? On which one, Travis? We saw it a little bit more over here on the, not really gap ups. Yeah, still not really gaps. That's a gap right there. That's just trading ranges. But remember our other trading observation about human nature. You can see there's pretty much a resistance level right here at the 50. And what do we know about human nature? When they come up through a resistance level, what do they usually do? They come back and test it to see if it's going to act as support. So tomorrow, if this market opens positive, what's our assumption? We're still in this uptrending channel. Now, if we extrapolate this type of information, Steve, that's true too, but you take all the information that's out there. You've got brokerage firms that are upgrading or downgrading the stocks. You've got political crapola going on all the time. You've got interest rate fears. You've got rockets being sent into foreign countries. All that is information you could try to sit here and evaluate. But the most important evaluation is, what is the market actually doing? And what the market is actually doing is based upon everybody else having all that information and seeing what their decisions are based upon that information. So let's start digging through some of these. Oh, pshaw. Let's do that. We recommended this one because we could recognize what investor sentiment pattern was occurring. This is your classic pattern, fry pan bottom, J hook. Now remember, a J hook can pull back and go up, or it can go sideways and go up. So when they broke out right here, what did it tell us? It told us we're probably in wave 3. And what was it doing today when the market was kind of lethargic? We're still in wave 3. There are a ton of stocks, a ton. Yep, I'll find them. Yeah, Bill's kind of expressing that thought. And that thought is, how many times have you seen a company come out with great earnings and the stock crashes? Or a company comes out with bad earnings and the stock starts skyrocketing. Remember, we're looking to see what investor sentiment thinks of news events or what's going on in a company. So good earnings might not have been good enough what everybody was expecting, or bad earnings weren't as bad as everybody was expecting. So you have to see what everybody else thinks. A lot of people always ask me, what do you think the market's going to do from here? Or where do you think the market's going to be 2 months from now? I have no earthly idea, and I don't really care. All I want to do is see, what is it telling me right now? So anytime we see a strong signal, like we saw in here, there's your kicker signal. It was consolidating. So if I had been trading this one, look what the Japanese rice traders tell us. Where do most people buy? They buy exuberantly at the top. How can we tell that? Because they start moving it up excessively away from the T-line. So if it was trading way up here, one of the things we're going to point out this weekend is we go to our 10-minute chart and start using the 10-minute T-line. Now look what it's telling us. They haven't closed it below the T-line. If we had traded out of it here, now we can get ready to buy it back on positive trading. The same thing happened in this one. If you stopped out here, you could be buying back here. Now, I point this out because there's so many times before candlesticks came along, that if I had a profitable trade, which was few and far between, if I stopped out here, I wasn't going to buy back here because they weren't going to fool me and get me back in and then turn it around again, whoever they may be. But now, if we understand they is how markets or how prices react because of investor sentiment or investor human nature, we now have control of what should be going on, not what we think is going on or what they're trying to do to us personally. So this one is a setup for analyzing what everybody else might be analyzing as far as right off the 50 and they're buying, that gives us that much more confidence that everybody was buying because they saw it supporting on the 50 and they started jumping in. We could see that based upon the signals that were being created at that level. We also know that once we're in a good trade, when is it time to start taking profits? Well, if you're in an uptrend and you're that far away from the T-line, you probably would close this one out, because what don't you want to see based upon human nature if you're in a strong uptrend? You probably don't want to see it close back below the previous day's open. That would have been a high probability situation to close out the trade and take profits. What's the worst case scenario? They turn it around and bring it back up through this level. You can always buy it back. I've gotten very comfortable with the fact that if this was a 10-point move and I only got 7 points of it or 8 points of it, meaning I gave some back, but every time I was in it when the probabilities were in my favor, it was going up. It doesn't matter. I only got 7 out of 10 points. I got the profitable position in there by being in the right direction at the right time. We also have the T-line that gives us a very steady eddy evaluation. We could see when this broke out. There was kind of our little J-hook pattern. We could see when it broke out. There was our cradle pattern. Now, how much time do you think you have to spend analyzing what to do with this trade every day? Approximately 3 seconds. So no matter where it is, if I've got 10 positions on, I look at this and say, oh, we're still above the T-line. Next day, still above the T-line. It takes me about 3 seconds to realize, whoops, they opened this lower, but closed it back up. We're still above the T-line. Might be getting a little bit dicey. Now I have to spend 30 seconds to say, all right, if this opens lower tomorrow, they failed here at the 200, close out the position. What do I say today? If you're using the T-line as support, just stay long. Okay, and so this is how how you can use the T-line to, and I say this with great conviction, it keeps your emotions out of your trading. Because once I started becoming very comfortable with the T-line, there's times when things look dicey. I just say, we'll wait and see what happens if it closes below the T-line. This gives you these steady eddies, the patterns that we expect, the 45 degree, and our trading rule. How long do you stay in a 45 degree? Until you see a sell signal and a close below the T-line. On the short side, works just as effectively. You stay short until you see a buy signal and a close above the T-line. Are there times when it looks like they're going to reverse it? Yes, but what was the final decision? Never closed above the T-line. Now, here's another little tidbit. You can see what it did today. We're in the oversold area. Big downtrend. We're down here with a doji right about the support level. Except what did it do today? It closed here yesterday. It gapped down and it traded as a doji here. That is not a very good bullish sign. That tells me if they open this lower tomorrow, you could still be putting puts or put spreads on this one. Okay, I'll go real quick to intraday charts. I was trading lean hogs today. You could see on the daily chart, it was absolutely doing nothing. But early in the day, it started trading lower. Looked like it was rolling over. So when it was doing that, I go to my 10-minute chart, and there's my 10-minute chart. Yep, choppy, choppy, you're out of the trade. Whoops, you're back in the trade going short right here. But then it was choppy, you're out of the trade. Then it did this, which was unexpected. Now you're looking at a 5-minute chart. This is the 10-minute chart. You can see it was a little bit more decisive that there wasn't an uptrend yet until right here. So had a doji, had a stop right there. Then it did this. Didn't go after it. However, look what happened up here on the 10-minute chart. Look how far away you are from the T-line. So if you're going to trade this, if it probably comes back down through this area or heading in that direction, where do you think it was going to? At least coming back to the 10-minute chart. I'm sorry, the 10-minute T-line. Well, how do we know it's going to do that? And you flip back to the 5-minute chart. 5-minute chart says it's rolling over. Now the 5-minute chart is starting to trade back below the T-line, which means it's probably heading back down. And this became, again, a very good short trade going into the end of the day. The shadows, yeah, that's stuff you have to kind of either sit through or see where those shadows ended. Again, we're over here on the 5-minute chart. On the 10-minute chart, you can see, yep, they took it up. Maybe you stopped out here. Came back down. All right, get ready to go short again. Took it back up. So what can we assume this is doing right in here? It's going sideways. So you're probably not trading this very much. What are we looking for? I was looking for it to break down. So when it did this, it wasn't there. Actually, I was in it and I stopped out here, so I gave some back. But then when it came up here, now we could make the T-line assessment that look how far away we are from the 10-minute T-line. We're starting to see sell signals. So on a quick trade, where do you think it's likely to go to? Back to the T-line. That was a high probability trade. Now what do you do when it gets to the T-line? Wait to see whether it's going to bounce back up, close out the position, or if it goes through, you stay short. So there are times where they take it up and they slam it back down. You get ready to go short because you think this is rolling over. Then it closes here. So you might take a small loss, small loss, small loss. But then at the end of the day, you take a big gain on that trade. This was just the cost of doing business. You could probably look at all, and I do look at all sorts of charts. You could see you had patterns here if you were trading soybeans during the day. There's your fry pan bottom. There's your morning star signal. This chart is the 10-minute chart. It could just as easily be an hourly chart or the daily chart. You can see everything looks exactly the same. There's your dollar. When it broke through this level, which way do you think it was going? Down, might have covered it in here. Now the one thing, and we'll do we might want to do a day trading session again on a Saturday morning. One thing I've discovered is you've got a big move like this. Once you see the first buying or buy signal confirmed, you close out the trade. Because what's that basically telling you? They finally reached a level where the bulls and the bears came into equilibrium. And then look what happened after that. It just basically traded flat from there. So they reached the level. That means get out of that trade and go on and find something else. Okay, so Where were we? So this is what soybeans, now this is what the dollar looks like on the daily and selling it off. This was what the dollar looked like over here on the daily. Bullish uptrend. So how would we be trading this during this time frame? Probably going to the 10-minute chart and trading predominantly to the bullish side because we saw the daily was moving in a bullish direction. Right here, move this over. Right here, how would we be trading this? You're looking at this and say, wait, we have no idea which way this is going. Let's go someplace else. What we're trying to do is we're trying to trade a trend. Okay. Whoops. So here's another one that we can assume that when they hit the 34, did a doji, gap down through the T-line, what type of pattern can we see setting up? A bearish J-hook pattern. So this is a firm. If the firm opens lower tomorrow, you can be shorting it. Because what's our expectation? Wave 1 and wave 3 are likely to be the same. Now that's going to be a function of seeing how the pre-market futures are opening tomorrow. So if we wake up tomorrow again and see that the Dow is going to open up down 140 points, well, we can assume the downtrend is still in progress. If the Dow is going to open up 140 points, we can assume the T-line acted as support, so we're probably not going to be as aggressive going after short positions. We're going to go after the long positions that have bullish chart setups. AMEH. Look at the probabilities of this. A failure at the 50. A doji. What was our setup for this one? Well, if they opened this lower, started trading lower, what did we have going on? A bearish doji sandwich telling us they aren't going up through the 50 anymore. They're probably heading down. And what confirmed that they were heading down? They're now trading back below the T-line, telling us we're now in a downtrend. So this is not rocket science. This is just identifying the signals and the confirmation indicators that tell us when investor sentiment has turned around. Oh, no, it's not a blue ice failure because it's not at a level that everybody is watching. Remember, it's only at a level that we know work well, the 8 exponential moving average. Now, if it bounced up and hit the 50 and faded, that would be a blue ice failure because everybody is watching to see what happens at the major moving averages. So another indicator is the biggies. Now, Apple still wouldn't be a buyer of this just yet because the market's not really showing a lot. Probably would watch to see if they can continue the uptrend and then see if they break out through the 200. That becomes your bobble breakout. NVIDIA had good earnings, but look where they ended up today. They're still trading here at the T-line. The Stochastic's heading down. So what's this tell us about the direction? Nothing yet, but we do have a doji, which says if they open this positive, I have a J-hook pattern setting up. If they open it negative, you've got a blue or a bearish doji sandwich, probably still heading down. All right, and Tesla, let me go through these real quick. Tesla, kind of the same scenario. Hit the T-line, sold off. If this opens lower tomorrow, doji sandwich, wave 1, wave 2, wave 3. We did Amazon. Whoops. And Netflix. What's this one telling us? Look how far away they were from the T-line up here. Well, pshaw. Then you started seeing selling. Where do you think the next target was going to be? Back down here to the T-line. Now what's it doing? Well, we have to wait and see what happens after the doji. So we have the T-line to add to the analysis of what's going on in investor sentiment. You can see when it broke out, maximum. How long do you stay long on this one? As long as you don't see a sell signal and a close below the T-line. This one, gapped up through the T-line, showing strength. Strategy already set up for you. If it opens positive, you're buying. Where's your stop? You don't want to see it close back below the T-line, which would be up a little bit higher tomorrow. So you know when to buy. You know what would confirm. Let's make this bigger. You know what would confirm this uptrend. Positive trading. And you know what would negate it. Coming back down below the T-line. How do you use the 3 T-line when price is far away from the T-line? The further you move away from the T-line, the more relevant the 3 T-line becomes. So if you're seeing a sell signal way up here and it closes below the 3 T-line, where do you think the next target's going to be? Back to the T-line. So if I saw this situation, again, use the simple rules the Japanese rice traders tell us. Where do most people buy? They buy exuberantly at the top. How did we know that? Well, they gapped it up in the overbought area. Now look what happened. They gapped this down the next day toward the low end of the previous day's candle. That's not a good bullish sign. You're probably taking profits right here. If not, if it opens positive and starts trading positive, where do you put your stop? Right here, because logic says if they come back down through there, they're heading back to test the T-line. Whoops, I'm almost used up a full hour, and we're just getting to the news. So here's that gap up from a doji off the T-line. There's your 45 degree. There's your gap up off the doji into new territory. There's your 45 degree. These patterns work the same way time after time with a high degree of probability. So it's not like we're shooting from the hip. We're actually analyzing what human nature normally does. So now we've got wave 1, wave 2. If this opens positive and trades above this level, what do we got going on? A J-hook pattern, wave 3. Whoops. What did this one tell us? Well, they wiped out a lot of sellers, and they're still in an uptrend. Where do we usually want to see the big price moves? At the end of a fry pan bottom breakout. What would be the strategy tomorrow on this one? This opens positive. You want to be buying because you got a fry pan bottom breakout with a strong signal telling you the bulls are definitely in control. Same type of chart in a strong sector. There's your J-hook pattern breaking out on First Solar. There's your piercing signal off the 50. What would be our confirmation? Positive open and a close above the T-line. What would that tell us? They came up through the resistance level. They came right back to the resistance to see if it's going to act as support. Why does this become a good, strong price move? Because everybody and their brother that's watching to see what it's doing at the 50 says, oh, they're supporting at the 50, let's start buying. Okay, thank you, Marshall. WB has earnings tomorrow. Do you have any other indicators on your chart besides what you show here? Nope, this is it. That's because there is one strong criteria that could eliminate everything else on this chart, and that's the signals themselves. Using stochastics kind of enhances where those signals are occurring. So I could take everything off this chart, use the stochastics, the signals, and then if I wanted to have the T-line, take everything else off, because that's going to give you good, accurate reads of what's going on in human nature. Anything else that you add onto your chart, like the 200 and the 50, which is where everybody in the world makes their decisions about their portfolios, that just enhances seeing signals or at those levels, telling you what the major money managers are doing at those levels. So that goes back to the simple education of candlestick analysis. If you just learn the 12 major signals, 6 longs and 6 shorts, that is going to give you a very strong, what do I say, probability analysis of what's going on in investor sentiment. The reason is because those signals are what the Japanese rice traders have illustrated for us from 400 years of experience. So when I first started learning candlesticks, I said, well, this can't be true. This is too easy. And so there were so many times I'd say, well, that looks like a buy signal, but oh, they're talking so bad about this sector or this stock, it can't be time to buy this. And it would go straight on up. So I'd look at the next one and say, oh, buy signals. Oh, but that can't be true. This is a bad sector, and it goes straight on up. It didn't take too long to realize when I was looking at these signals, it wasn't because somebody was thinking about buying or selling. This is actually what they were doing. This is their actual decisions are built into these charts. Boy, do I get off topic here, don't I? So if we look at a market that looks like this, in the overbought area, consolidating, are we going up or are we going down? At this point, hard to say. However, there are good charts telling us we can be short, which is what we're going to go through right now. So because of the simplicity of candlestick scanning, at any given time, whether the market's going up or going down, we're going to be able to find 5, 10, 15, 20 good bullish signals. We're going to be also able to find 5, 10, 15, 20 good bearish signals. Now we can get ready. We don't have to know exactly what the market's going to do tomorrow, but once we see what it's doing, say it's selling off, say, oh, I've got some good shorts. Let's go after them. If the market's heading up, I'm disregarding the shorts and probably looking at the long picks that we found. WST. This is what I call observe the obvious. You observe the obvious is you can see there's a resistance level right here. You can see they failed at the 50. You can see that they traded back below the T-line. The stochastic's heading down. What's our high probability assumption? At least they're probably heading back down to the bottom of this channel. We could be, with all that evidence, we want to be going short. Team. You can see the J-hook failure at the T-line. If this opens lower, what are we expecting? Wave 1, wave 2, going into wave 3. I'll try to run through some of these real quick. Same thing. Here's a resistance level. Here's a evening star signal. Here's a gap down through the T-line. What's our assumption? First target, second target. Carvana has made us a fortune. Because it's been so easy to identify what the trend is. Every time we saw a candlestick sell signal and a close back below the T-line, if we cover short positions here, we're re-shorting here, and it just stayed below the T-line the whole way down. Let's see, we did net. Twist. Failure. Gap down through this level. What's that gap down imply? They're going to keep taking this right on down. We saw that a while back in Netflix. I'm trying to think of the other ones that they sold off hard. There's your bearish kicker signal. So if you look back at this chart, it becomes pretty obvious when you should have closed out long positions and going short. Mark, probably not. We might, I don't even know whether we'll do something Wednesday night. There you go, Steve. So look at your evening star failure right here at the 50. When was it time to go short? When it closed below the T-line. When was it time to take profits? Probably when it came back up through the T-line and the top of that doji. When was it time to go short again? When they did a kicker signal to the downside, still heading lower. When was it time to go short on this dumpling top? When they started, look at your doji sandwich right here. Where do you think your next target is? Right there. Where's your next target? Down here somewhere. Wayfair. Same scenario. Bearish best friend. Then they gap it down below the T-line. Where do you think your next target is? At least down here. And, whoops, no, I got a few more. Observe the obvious. Where did they fail? Right at a level everybody else was watching. At the 50 that had failed before. First target. Second target. Match. So here's another illustration. Oops, come on. Get up to there. I'm buying this based upon what looks like a strong best friend breakout, fry pan bottom. Where do we expect the breakout? Right about there. And when they gap it down and do a bearish kicker signal at that level, what's that telling me if I'm long? Get out of that trade. They didn't break it out. Now they've gapped it down back below the T-line. What's that telling me? Probably coming back down into this area. So again, visually, we can recognize where patterns don't work and what our next target is likely to be. Now, if this target was 6% away, say, this target is 15% away, say, no, that's worthwhile. Let's do something. Now, is there a reason to go short on this one? Well, if they open this lower, what do we got going on? A bearish doji sandwich, which implies more downside. Do you stay in or out at the earnings? That is usually predicated on how are they trading it going into the close of the afternoon that they're going to report earnings. If they're trading it off, you got to think, well, the people that know what's going on are getting out of this. You better get out. On the other hand, if they're going into earnings and they're buying going into the close, that means somebody that's probably a lot more closer to the company than we are knows something. So I'd stay in. But remember, the probabilities are it's going to move in the direction of how things were going right before the earnings. That's probabilities. Sometimes you get slammed. So the other way to trade it is, if it doesn't look good or you don't know what's going on, close it out. Then, after they report their earnings, it's going to form some sort of signal or pattern. Now you can get back in based upon the direction you think it's going to go after that. Okay, one more. $5N. Look where it kind of failed, right there. Now you're trading back below the T-line. If you use the T-line rule, you see a sell signal and a close below the T-line, and your stochastics are rolling over, the probabilities are pretty strong you're heading in a specific direction. That's why we're doing the T-line this Saturday, because, again, it's like finding that nice, clean golf ball in the tall grass. You know it's free money. You have a much greater perspective of what the direction is going to do with the combination of the signal, the pattern, the stochastics, and then where is it trading in conjunction with the T-line. And it helps you stay in trades. Keeps your emotions out of your trading. And it also tells you when to get out of a trade. If you're in an uptrend, what's the trading rule? You close it out if it closes back below the T-line after as a sell signal, because that's what you don't want to stay in for. As soon as it closes below the T-line, and this is, again, 15 years of using the T-line, I can show you what the probabilities do based upon where you are at the T-line. All right, so with that, are there any questions on candlesticks? How do you determine Marabuzzo? That's part of the keeping your emotions out of your trading. If I've got a portfolio of X number of, say, $250,000, I'm going to have 10 positions on, all equal dollar amount. So each position is going to be $25,000. Why? Because of my emotions. If you have a $40,000 trade or trade on, a $10,000, a $12,000, a $22,000, an $8,000, where do you think you're spending most of your time? Watching the $40,000 trade. And if it doesn't do what you thought it was going to do based upon your analysis, what do you do from that point? You hold on to it and say, oh, I analyze this is going to be a great trade. I'm going to hold on to it for a couple extra days, let everybody else catch on to why it should work, and you hold on to it too long, you take a bigger loss. When each position's equal dollar amount, I look at it and say, what is this unit of my portfolio doing? Doesn't look good? Close it out. Move on to another unit of the portfolio. Yes, Jerry, all it is you're adding the 8 exponential moving average to your chart, just like you would add the 50-day simple moving average to your chart. It will give you options. Derek, it's supposed to go from 10 a.m. We take 15 minutes for lunch, and it's supposed to go to 2, but it never does. We're usually done around 4, 4:15, 5 o'clock. VG, no, I didn't. Only because I was thinking things were going down on hogs. So when I stopped out, I didn't really have time to, and I think I was in the chat room and the options room at the time. I really didn't have time to say, all right, I'm going to go long here. I just stopped it out. But then when it got up here, in here, and that's where I take from the T line, figured, all right, let's short it if it starts showing weakness. Sound is gone. Dennis, yeah, hold on. We'll get to when I tell Jim to do the double line and put in your request. The thrill is gone. All right. Wayfair. Wayfair. Am I looking at this? Oh, I'm looking at the 10-minute chart. Yes. Remember, oops, let's get rid of all of these. What is your rule of the T line? There's your kicker signal. But then, so what should we be expecting? An uptrend. But what's the next signal? Well, there's your doji best friend gap down. What happened right here? We were still above the T line. When it opened lower today, what was that telling you? You're below the T line. Close it out. That means this uptrend is over. Okay. Any chance of the price of bacon will go down soon? I don't know if bacon. They got rid of the pork belly market. And I kind of figured the reason they did that is because the pork belly traders were, I was going to say they were one step above thieves. They're probably one step below thieves. VG, you could have gone short today, yes. So if you had gone long, well, that would have been a warning up there. And you were up in the overbought area. So if you were long, where was our safety stop, or where should your safety stop have been? Right there at the low of that doji. Because logic says they're going to move in the direction of how they open after a doji. But when they gap it down, what's that telling you? The bulls aren't there, the bears are there. Close it out quickly. Okay. I guess with that, Jim, let's go ahead and do the double line. Oh, somebody private messaged me. Yes, we're going to be going through hundreds and hundreds of charts on Saturday. So when you walk away from Saturday, the thing that you will have learned is not something that you say, well, I learned about this or that. What you've learned is when you visually identify what's happening, you say, whoops, that chart is telling me I should be doing this or doing that. Kicker type signal, breaking out of this flat trading. First thing you do on this is say, all right, let's do our rare process, research analysis, reverse engineering. There's big bullish sentiment. Let's go see if there was any news and see what that news was that created that move. Horizon, that's kind of a nothing chart. I would, well, if you're long, that'd be a toughie. That's just not a very exciting chart. If you are long, it has to open positive and trade positive and get up above the 50. The 3T line is the 3 exponential moving average. You put that on your chart just like you put the 8 exponential moving average or the 50 simple moving average. It acts as a double confirmation. One, if you're moving too far away from the T line, it becomes more effective. And two, it kind of confirms that if the bulls are taking control, the 3T line will come up through this level. Notice right here, you had bullish sentiment, but the 3T line never got through. So that was kind of a little warning that that this wasn't confirming. What happened here? You now had the 3T line coming up through. That was confirming. So it acts like a little extra confirming indicator. Chevron, all these got sold off today. How long do you hold on to these? If you didn't close out here, you were closing out today. Which means that's actually a green candle. If you held on to this, it has to open positive and trade positive. Now, you're going to be able to tell whether they're going to be buying or selling the oils tomorrow based upon what crude oil does tonight. Now, it sold off $4 today, trading up a little bit after hours. So either you've got a support level right here, but if you wake up tomorrow and you see crude oil down here, that's more than likely telling you the oils are going to be selling off some more. You'd close out positions that were trading below the T line. Deer, very simple. You stay long until you see a sell signal and a close below the T line. Advanced micro. Well. That's not what I want to do. There's your fry pan bottom. That's another thing you're going to learn on Saturday. What's the rule of the fry pan bottom? You can stay long as it doesn't close back below the T-line coming out of a fry pan bottom. Microsoft. That's still kind of a nothing chart. If you like it, you can see how it held at the 50. It has to stay above the T-line in the 50. More than likely, you want to see it get out of here. The reason I say is Microsoft really isn't a very good trader. It's more of an institutional long-term hold type situation. And Marvell, same scenario. You had kind of a fry pan bottom. There's your kicker signal. There's your bullish engulfing. But what was the final analysis? They've never been able to close this back below the T-line. You just stay long. If you want to see it open positive tomorrow, what you don't want to see is it close back below the T-line. Freeport, that one you get ready to go short. Not only do you have a bearish best friend that gapped down below the 50, which the 200, which everybody's watching, you also gap down below the T-line. And on top of that, you have what we call an island reversal. You can draw a circle right around, I hate that thing. Draw a circle right around this whole trading area without touching anything. That's usually a very strong reversal. Here, just stay long. So what do you want to see tomorrow? Definitely want to see it open positive and trade positive. You don't want to see it open lower and start trading lower. If it does, you close it out. You stay long on SMCI. Why? They've never been able to close it back below the T-line. ABBV, you can stay long on this one also, yes. But the same scenario. You don't want to see this open lower and trade back below the T-line. That means they aren't heading up right now. Fossil, stay long ever since your kicker type breakout. So when you see something like that, especially right here at a level everybody's watching, the 50-day moving average, look what happened right here. I say look what happened right here. It's surprising the number of times they will come right to the T-line and bounce back up. I think we did this one. Stay long on this one. Cuervo, stay long. This would have been a little bit dicey. There's kind of your evening star signal. If this opened lower and started trading lower, I would have closed it out. But the nice thing about the graphics of candlesticks was, you can see as soon as it opened, you started getting green candle. So now what becomes your strategy? If you were long, you just put a safety stop at where it opened, because logic says if they took it up and then turned around and took it down, it was time to be out of that trade. GFS, stay long. BTU, that's kind of a nothing chart. I wouldn't be long or short this one. There's no direction to it right now. VIPs, same scenario. Stay long. Kind of a fry pan row bottom that broke through this level. Just stay with it. Docs, nothing wildly exciting. You've got a slow uptrending channel. You can stay long. Wouldn't be buying it, but if I was long, I would just stay long. This one's still kind of a nothing chart. Which means you can see there's a resistance level. It has to get up through that level to stay in it. If it starts trading lower, obviously the 50 is acting as a resistance. CPA, all you can do here is stay long. Just realize that you're in a channel, so it might not be real exciting. BMRA, BMRN, another one where it needed to open positive and trade positive. Had this opened and traded lower, you would have closed it out because that would have told you the 50 was acting as resistance. Right now it's telling you it's not acting as resistance. You stay with it. International paper, if you're long, it is a fry pan bottom. It needs to stay above the T-line, which it's doing so far. So very simple. I want to see this one open positive and trade positive. If it trades back down through the T-line, it's coming back down to the 50. You probably want to close it out. Overstock. Get ready to short this one on weakness. Failure right in here with a dark cloud. Devon oil. Kind of a nothing chart still. Just moving sideways. Square. This one, very simple. It has to open positive if you're long to maintain that kicker signal. Just make this bigger. If it opens lower, close it out. Etsy. Whoops. Well. Fat fingers. Look how far away you were from the T-line. When it opened lower, what would you have done? Close it out? Because where do you think it was heading to? Back to the T-line. Then you can make a decision from there. Right now, this one has to open positive to stay in it. This one you can stay long. Estee Lauder. Obviously, you want to see it break out through this level, confirming the uptrend. United Health, nothing here. If you were short, I would have covered the short, but I wouldn't be going long. This Foot Locker, nothing. No, I wouldn't be going long on this. You're still in a junky mode. And that one, there's nothing on that chart that would get me excited. First of all, you don't even have a trend, and you don't have anything strong enough to say it broke out. Now, there's a good short. Failure, shooting star doji, bearish confirmation, gap down. I would suspect first target and then second target. CP. J-hook. Not really a J-hook, no. All that is telling you is they're staying above the T-line. No, I wouldn't be. You could, let's put it this way. There's tons of other stocks that are much better than this one right now. So that would not be one that I'd jump in just because, again, there's better things. The Russell, that sold off and didn't get back up above the T-line. So, I would suspect that one's heading lower. Now, that's kind of a nothing chart. You hit the resistance level, I'd be someplace else. Netflix. This one has to open positive and trade positive to stay in it. long. If it opens lower, I would think now they're coming back down into this area. And Amazon, same thing. If this one opens lower, you want to short it because now you have a bearish J-hook pattern. Gapped up on earnings. All right. So we want to check the earnings. And this is a doji type day. Gap up kicker. So what's our trading rule? It's going to move in the direction of how they open it. So if they open this positive, they're going to take it probably in a 45 degree. That was the reason we bought this one. Gapped up, doji, bullish the next day, 45 degree. TSEM. It's got to get through the 50. It starts trading lower tomorrow, telling you that it can't get through this level. Move that money someplace else. Can he switch to a smaller time frame, do the same that the 3T line would? I have the 5 EMA for a different person, so I want to avoid the 3. VG, I don't know. So the answer to that is, this isn't sophisticated analysis. If you think something will work, some people say, well, why don't you use the 10 simple moving average versus the 8 exponential? If you want to try something different, put it on. If it works, keep it there. If it doesn't work, take it off. The T line is the 8 exponential moving average. Raj, same thing. If they're working for you, work or keep them. Again, I've used the 8, the 3, the 34 exponential. Works well. And then I see what everybody's doing at the major moving averages. Yes, this is being recorded. VIPs. Well, you got kind of a scoopish type pattern. So it needs to confirm getting through this area. Again, getting through the 50-day moving average. HCC, nothing here. If you're short, I'd probably have covered the short. You're in the oversold area, seeing buy signals. If you're thinking of going long, you still wait for it to close above the T line. Price will fill them eventually. Volume is as close to a leading indicator as you can get. Of course, the lines crossing the 8 over the 21 is my signal as well. And if the volume is adequate, I'm good. All right. Apache, I'm sure sold off today. Yes, so you would have closed this one out today. IEP, look at your dumpling top. So you would have been short on this one because you wouldn't have been long with it closing below the T line, and you can see the dumpling top. Now you can short this one if it starts showing weakness. Expect more downside. J-hook pattern is just wave 1, wave 2, wave 3. What creates wave 1? Strong investor sentiment. What creates this little move here? Consolidation. What creates this move here? The continuation of that original strong bullish sentiment. No, you're not buying the T-line. You're buying the price movement. If this starts trading as a 45 degree, the T-line will catch up. Could we get a legend? What are all the other lines? Well, I can tell you real quick. 200-day simple moving average. 50-day simple moving average. Every major money manager around the world uses those to make their decisions. Then the T-line, the black one. The gray one is the 34 EMA, and the little green one is the 3 EMA. Yes, and that Jim posted that up above. Yield, there was your fry pan bottom breakout. There's your 45 degree. How long do you hold on to this one? As long as it doesn't close below the T-line. Why does her have stochastics there? He is not using. Why does he have stochastics there? He is not using it. Stochastics are identifying a buy signal in the oversold area. A pattern breakout will usually occur when stochastics are in the overbought area. We're not using stochastics to make our decision. We're using stochastics to tell us whether we're in the overbought or oversold area. Obviously, a candlestick buy signal in the overbought area doesn't mean anything. Can we see Hasbro? Right now, if I was short, I'd stay short until I saw a buy signal or close back up above the T-line. NOC, that one, not a real good signal, kind of a doji sandwich. You could buy it, it just wouldn't be, not a real great chart. Bath are on the uptake. No. All right. Why do you have the 3T line? Again, it becomes more effective the further away you move from the T line. It's a minor indicator, but it's not cluttering up the chart. Now, if I had 15 more moving averages on here, probably get confusing. The reason there's so few on here is the most important factor is the signal itself. Did you get rid of purple for T-line on platforms? I don't know. Probably by this time. The RSI works the same way. So if you don't know whether stochastics work better than RSI, put both of them on and see how they work. Wheat right now is still in just kind of a junky slow down trend. And corn, might be starting back up. Kind of your morning star type signal. You could be buying those, or buying corn anyways. You were not on VPS regarding too many. Oh, you were not on VPS. You are not on VPS. Oh, as far as the gap ups is all included in this pattern. So as long as they're staying above the T line, The gap ups are still showing strength. That was kind of the reason we were going after sedge. They were gapping it up. They were gapping it up. Usually has a lot of follow through. All right, so tomorrow, the futures are still just kind of sideways. The Dow, not doing anything great. Still putting everything in the classification of you can have some shorts and longs in the portfolio. CTIC, yeah, kind of your classic, but more importantly is when they broke out through the 50, look where they came back to, right smack dab to the 50. So if it started trading positive, wouldn't be afraid to be buying. You would already have your trading strategy in place. But if it opened positive, you wouldn't want to see it close below the T line. If it opens positive, you want to see it get up through this level. Why don't you give trade alerts? Well, we do. Each night I put out 2 or 3 stock picks in the members area. And then in the morning, we do a morning comment and an afternoon comment of what you should be doing with those picks. So what did we have today? One of them was LODS. Our strategy was if it opened positive, wanted to be buying. There's a J hook. Well, it opened down here, so it didn't execute. How do I get into the members area? Raj, email Abraham if you're not a member, and he'll show you how to sign up. Oh, Becky's got it there also. Yeah, so we've got a chat room each day, about 150 people in there, but you've got people that already know how to pick out the best trades, and then you've got people in there that if you ask a question, they're going to help you with the answer. Raj, right above you is the link. All right. So the first analysis every day is which direction is the market moving? If this opens up where it's down 140 points, look at the short positions that you've scanned for. If it opens positive, look at the long position. All right, everybody. Have a good evening. We will see you. When do you roll over the futures? When do you roll over the futures? Thomas, ask that again. I don't know what that means. Bob, are you up near Lake Ontario, New York State? Near Buffalo, yeah. I've got friends over in Watertown, and they're expecting 4 feet of snow tonight. All right, everybody. We'll see you bright and early in the chat rooms tomorrow.